Welcome back to The Critique. Today we're looking at a piece that analyzes the sharp drop in European defense stocks after news of peace talks and what that means for the sector.
And we need to jump right in because there's a lot here to maximize the strategic depth.
Okay, so a key theme running through this is that immediate reaction to what's seen as diminished future demand. The material correctly notes the sell-off was triggered by this potential reduction, which, analysts like JPMorgan are already arguing is maybe premature.
It is, and the piece captures that initial investor panic very well. The fear of easing conflict means a drop in what we could call emergency orders.
But the focus on that immediate market reaction, that short-term feeling,
That's the weakness. It's understandable, but it strongly emphasizes this sentiment, this fear of reduced orders.
Bring the deeper forces at play, doesn't it?
Exactly. The analysis leans so heavily on the immediate sentiment that it almost misses the deeper, longer-term rearmament mandates that are now locked in across Europe.
You're talking about Germany, Poland, the UK?
All of them. These budgets are driven by systemic security concerns, the long-term threat posture of Russia. That's not going away, regardless of what happens with the immediate, high-intensity conflict.
So the fear is that peace talks mean governments just stop writing checks.
Right.
But the reality is that the checks are being written for a whole new geopolitical reality, not just for the war itself.
Precisely. The argument that this is a buying opportunity, it's just not sufficiently anchored in that new geopolitical floor for defense spending.
That feels critical. We need to clearly separate the different types of demand driving this market.
And that's the suggestion. You have to draw a very clear line between, on one hand, the volatile, conflict-driven emergency demand.
Which peace talks definitely affect.
Absolutely. That's immediate material replacement. But on the other hand, you have this stable, structural rearmament demand. And that's tied to things like NATO's 2% targets and the national strategies put in place right after the invasion.
So if we frame the buying opportunity within that structural context, it makes the whole argument that the sell-off is premature much more robust.
It does.
But how do we actually show that? How do we prove that structural demand stays strong even if the fighting stops?
We have to get into the concrete examples. The piece mentions government defense budgets as a watch point. Great. But we need to analyze how a peace framework would shift the focus of that spending.
So a shift away from, say, just replacing artillery shells toward more advanced platforms?
Exactly. Think about the production cycles. A lot of the emergency demand was for immediate stuff, artillery, light armored vehicles, things you can consume quickly.
Right.
If the intensity of the conflict drops, the focus shifts to strategic capabilities, things like integrated air defense. That's a massive, multi-decade structural need across Europe now.
Or things like cybersecurity, next-gen fighters, the FCAS and Tempest programs.
Yes, those projects are politically and strategically cemented. They are not dependent on a local ceasefire.
So the advice here is to really analyze how a firm like Rheinmetall, for instance, would fare compared to, say, BAE Systems if demand shifts from immediate procurement to these longer cycle platforms.
You've got it. BAE, with its huge involvement in naval and aerospace, is probably more structurally insulated than a company focused just on ground equipment.
Yeah, that makes sense.
So the analysis should detail that. If Germany finally hits its 2% NATO target, that spending becomes very, very sticky. And if they shift from rapid tank production to long-term missile defense projects, that changes everything. R&D budgets, contract duration.
It's a much more nuanced view of risk versus opportunity. The sell-off, then, is really just short-term sentiment completely overwhelming the long-term policy reality.
Exactly.
Okay, that expansion really grounds the whole piece. Now, if we accept that the structural floor is high, the challenge becomes dealing with all this short-term volatility. Which brings us to our second point.
The commodity link.
The link to gas prices. I thought this was a really insightful observation, and it should be used to build a more sophisticated predictive model.
I agree. It's an incredibly strong observation. The material shows that gas prices dropped, commodity signals dropped, everyone's feeling better about the conflict easing.
So it ties the defense markets to these broader economic factors.
It does, but right now, it's being treated as a parallel consequence. Dropping gas prices signal optimism. They just confirm what the peace talks are already suggesting.
So the correlation is there, but it's just being used for confirmation. after the fact.
That's the weakness. To make this analysis more robust, we need to elevate this relationship. We need to separate the hard data risk factors, like official contracts, which are slow, from the sentiment proxies.
And you want to turn this observation into a real-time predictive tool.
That's the move. It's a powerful one. The suggestion is to position European wholesale gas prices as a robust, real-time leading indicator of geopolitical sentiment.
Why gas specifically?
Because energy security in Europe is just so intrinsically linked to geopolitical uncertainty. The gas market reacts instantly. It moves far, far faster than any official budget update or contract announcement.
Let me push back on that for a second. Wholesale gas prices are so noisy. How do you filter out all the other stuff, seasonal demand, storage levels, to isolate the geopolitical risk premium that's actually hitting these defense stocks?
That is the critical distinction the analysis needs to explore. It's not just about the price level. It's about the extreme volatility and the velocity of the movement.
Ah, okay.
Standard industrial demand shifts, those are usually pretty gradual. But a sharp, rapid downward spike when peace rumors surface, that is almost entirely the market shedding that geopolitical uncertainty premium.
And that gives you a timing edge.
A huge edge. You're using the energy market's movement to anticipate the risk-off rotation out of these defense stocks, completely independent of the slow-moving news cycle.
So you're basically using the liquidity of the energy market to gauge investor conviction and then applying that to the much less liquid defense sector.
Absolutely. And here's how you could implement that. Suggest modeling how extreme, rapid moves in gas prices could predict the velocity and the scale of the defense stock rotation before any official announcement is made.
So if gas drops, say, 20% in 2 days.
That level of conviction is a massive signal for anyone trading defense stocks. It turns gas prices from just a confirmation tool into a proactive, actionable timing signal. It moves the whole analysis from descriptive to truly predictive.
It turns a commodity price into a technical signal for asset rotation. I like that. And that shift to predictive modeling brings us perfectly to our third point, which is about getting more granular at the firm level.
That's right. The piece introduces a really critical idea in its broader implications section.
The potential for government budgets to shift away from arms and towards, say, reconstruction.
Critical idea, but it needs specific firm-level scenario exploration.
Right. It's a very relevant point. If peace advances, spending might shift, and that affects these companies. But the materials sort of lumps them all together.
And that's the weakness. The analysis is incomplete because it doesn't actually stress test the business models of the specific firms listed, Rheinmetall, Rank, BAE, Leonardo, Saab, against that budget pivot.
The assumption is that they're all equally exposed, which they can't be.
Of course not. It limits how actionable the insight is for a serious investor.
So we're not just looking at if spending shifts, but where these individual firms are exposed in that budget.
Exactly. The suggestion here is to add a proper scenario analysis, assess the diversification, the product lines, identify which firms are pure-play military suppliers.
The most vulnerable ones.
Most vulnerable to a sudden shift away from high-end procurement. And then identify which ones have adjacent civilian capabilities that might actually benefit from big infrastructure or reconstruction spending.
Okay, let's make that concrete. Let's take two of the firms mentioned. How do you distinguish between, say, Rank and Leonardo in that kind of scenario?
Rank is a perfect example of a high-risk exposure here. They're primarily known for highly complex gear systems for things like tanks, specialized naval propulsion.
Very specific.
Very. Their revenue is tightly coupled to these long-cycle, heavy armor procurement programs. So if the German government, for instance, decides to pause a big tank modernization program to redirect funds, Rank feels that acutely. They have very little diversification.
They're a pure-play component supplier. They're vulnerable because their specialization ties them to the most expensive programs, the easiest ones to pause.
Exactly. Now you contrast that with a company like Leonardo, the Italian giant.
Much more diversified.
Way more. Beyond their military systems, they have huge divisions in helicopters, civil aeronautics, cybersecurity, a lot of which have civilian applications.
I see.
So a shift in government spending towards, say, rebuilding airports or modernizing transport security could actually involve Leonardo's other divisions. They have a buffer. Their business model is just structurally more resilient to that specific political risk of peace money displacing the defense budget.
So making that distinction turns a broad idea like budgets might shift into a really targeted, actionable investment insight.
An expert knows they aren't just buying a basket of defense stocks.
Absolutely. You're stress testing their capital structure against a specific political outcome. To give one more quick example, you could contrast Rank's reliance on components with BAE's huge, decades-long contracts for submarines and naval ships.
Those programs are basically untouchable national assets.
Untouchable. They're independent of the immediate conflict, so the risk exposure is drastically different across the sector, and the analysis has to detail why. That's the level of specificity this audience is looking for.
That specificity is key. Okay, we've covered 3 major areas for improvement: anchoring in the structural floor, using energy data as a predictive signal, and then doing that firm-level stress testing. That's it.
So, to quickly summarize the actionable takeaways, first, anchor the analysis in that long-term structural geopolitical floor for defense spending. You have to clearly separate the stable, structural demand from the volatile, conflict-driven demand. Second, use that energy link to build a proper predictive model. Position extreme gas price movements as a real-time leading indicator, not just a confirmatory signal.
Right.
And finally, stress test the individual companies against that risk of budget shifts toward reconstruction. Identify who is vulnerable and who is insulated.
Exactly.
These steps will ensure your analysis is not just timely, but structurally robust and highly predictive, which is what your readers want. Implement these suggestions and please submit the revised analysis for a follow-up. We look forward to seeing it.